In this video, we're going to talk about real estate investing through the eyes of an investor, and we're going to talk about some of the key metrics we look at in order to determine whether or not something is a good investment, as well as some of the important considerations that go into determining whether or not it's a good time to buy in the direction that the real estate markets will take in any given year. And if you're tuning in for the first time and haven't subscribed already, make sure you smash that like button and subscribe to the channel. We put out weekly content on how to grow your wealth in real estate and build a portfolio from scratch. And after watching this video, post a comment in the comment section below, letting us know if you found this content helpful. So all of the metrics we will be looking at in this video will be through the eyes of determining whether or not something is a good investment by whether or not it produces one thing, and that is positive cash flow. And the three parts we're going to discuss are things that make sure you get a good investment. Number one is metrics that measure your rates of return or return on investment. Number two is cost of capital. That is how much the money is costing you. And number three, mitigating risk and analyzing risk factors. So there's several metrics that we will look at, but the biggest and most important ones are going to be the following. Now, number one is a term called capitalization rate, or cap rate for short. Cap rate is simply the value of a property divided by its net operating income after expenses but before debt. So for example, if you have a $100,000 property with a 10% cap rate, that means that your net income after expenses should be 10% of its value. And in this case, 10% of $100,000 is $10,000 a year. But this is assuming the property is paid off, so this doesn't account for interest expense or your mortgage payment. The reason I love looking at cap rate first is because if interest rates are higher than your cap rate and you bought a piece of real estate with debt, you will not make money on the property because the cost to service the debt, meaning make your monthly mortgage payments, will be more than the return on the value of the property. So if interest rates are at 6% and the asking price on a commercial property, for example, has a 6% cap rate, that means you will basically be breaking even if you financed 100% of the value of the property, which is not really a great or sexy investment, and this will not really yield you positive cash flow. Now, I will dive into this deeper in another video because it is a much deeper conversation, so make sure you subscribe to the channel and watch the video that's linked at the end. And the next returns I'm going to talk about are the returns that I actually care about the most, because these are a measurement of how much money I am making on my investment, which is important in determining how quickly I will make my money back. And these metrics are, number one, return on investment. Number two is a sub-metric of this, and it's actually the return I care about when talking about return on investment, and that's called cash on cash return. And number three is return on equity. Now, there are lots of other metrics in addition to this, but I am focused on these because let's say, for example, I was going to go live in real estate land and I could only take 3 tools in my real estate tool bag with me. These would be the 3 tools I would take, and I'll explain why. Now, return on investment is the actual return I'm getting on the amount of money I invested. So let's take a look at the $100,000 property I brought up earlier. Let's say I put 10% down, which in this case is $10,000. And let's say I was cash flowing this property $1,000 per year. That meaning that after I paid my mortgage and my expenses, I was making $1,000 profit per year. In this instance, I would have a cash on cash return of 10% because I invested $10,000 and every year I was making an additional $1,000. And the way I do that math is by dividing $1,000, which is my return on my income that I'm making every single year, divided by $10,000, which is the amount I invested. And in this case, I would make my money back in 10 years. Now, the good news is I'll actually make my money back quicker, because one thing that happens with rents each year is that they typically go up 2 to 3% per year to keep pace with inflation. And this reason alone is one of the reasons I love real estate, and that's because real estate investing is one of the few ways you can create an inflation-adjusted income for life, meaning that as inflation goes up, so do your rents, and therefore so does your income. And at the same time, your debt is going down every year because your debt is being paid by your tenants. Now, the number 3 metric I mentioned was return on equity. Now, the reason I love return on equity is that cap rate, cash on cash return, and return on investment help you determine whether or not something is a good investment at the time you buy it. But how do you determine whether or not something is a good investment on an ongoing basis? And this is especially important in real estate because, as you know, over a long period of time, the value of real estate appreciates and goes up every single year. And return on equity is a way to measure whether or not you are getting a good return on the amount of equity you have available on the property. And I'll give you an example. Let's take the $100,000 property I mentioned earlier. Well, after 10 years, let's say it's now worth $200,000. and in addition to being worth $200,000, let's say you paid down the loan an additional $40,000, so you only owe $50,000 on the property. In this instance, even though you put $10,000 down at the time you bought it, because the loan has been paid down at the same time, the value of the property has gone up. You now would have $150,000 of equity in this property. Now, equity is defined as the difference between the value of the property and the debt or mortgage that you have on the property. Now, let's also assume that your rents went up every year, and instead of making $1,000 a year like you were a few years ago, now you're making $5,000 a year because of rent increases. Well, in this instance, this would make this property a terrible investment from the perspective of return on equity, because you have $150,000 of equity available in this property, but you're only making $5,000 a year, which is a measly 3.3% return on the equity you have tied up in the property. And you might be thinking, well, okay, but don't I have to sell the property to access the equity? And the answer is no. And at the end of this video, I'll show you how the rich people access equity without selling the property and without paying taxes. And if you haven't done so already, please smash that like button and subscribe to the channel. It's a free way you can support the channel. It takes a lot of time and energy to put out videos like this, and it is much appreciated. So in a nutshell, those are the three big metrics I like to take a look at an ongoing basis when determining how good of an investment a property is. Now back to part two, and this is going to be your biggest determining factor when it comes to cash flow, and that is the cost of capital. So what is cost of capital? Cost of capital is the cost of the money that you are borrowing to buy the asset. Now, remember earlier when I was talking about cap rate and comparing it to interest rates? The reason being that if interest rates are close to the cap rate on a property, the chances of you being able to get a return on your investment is low, because interest rates are making borrowing against the asset expensive, and therefore it is difficult to make a return. That is why the biggest determining factor on whether or not something is a good investment is your borrowing cost, and that is what cost of capital means. For example, if you have cash and don't have to borrow money, you might not care as much, but you will always want a better rate of return on a piece of real estate compared to a treasury bond, for example, because right now, as of the filming of this video, you can get a treasury bond to pay you a risk-free return of 5.25%. That means that if you bought a $1 million bond, you would get $52,500 a year for doing nothing, and you would get that just for buying the bond. And at the end of the year or the bond term, you would get that money back plus the interest. But since most real estate, especially when you're starting out, is bought with debt, it's important to know what your cap rate is, meaning what your net income on the property is, so that you can determine whether or not it makes sense to purchase the property. But more than that, it will let you know what price you need to purchase the asset in order to get a return that makes sense. So just because a property might only have a 6% cap rate and interest rates might be at 7%, the easiest way to get a better return is to pay less for the property, and your cap rate will go up. And this is easier said than done, because not all sellers are reasonable and willing to sell a property for less than what they think it's worth. And lastly, we'll talk about part three briefly, which is analyzing and mitigating risk. Then when it comes to investing, risk is obviously inherent, and there's always going to be some level of risk. And if you've ever heard the expression big risk, big reward, it is actually not true and not how super rich people do it. The best way to take risk is in a way where you can mitigate or hedge against the downside. And all that this means is how you can minimize the risk. And part two of this equation is how you can get an asymmetric risk reward return. If you look at super successful investors like Warren Buffett or Ray Dalio and Paul Tudor Jones, they don't take massive risks in order to get big gains. They take a proportional smaller risk to make a potentially massive gain. So this means that instead of taking a $1 risk to get a 10% return, which would be 10 cents, instead you would risk $1 to potentially make $5, which would be a 500% return. And having a risk that is asymmetric is a great way to mitigate against the downside, because of the law of averages will kick in over time. And if you're wondering how to do this in real estate, it's very simple, and I'll spell that out for you now in one word, and that one word is debt. The reason so many people get rich on real estate is because you are able to borrow money to buy real estate that then turns around and produces income. This means that you're using somebody else's money in order to make money. So for example, you can buy an FHA home with 3% down. And if you're super broke, there's actually programs out there where you can buy an FHA home with no money down when you qualify for down payment assistance, especially for first-time home buyers. So you can literally risk 3% of the purchase price, which is the only money you have to put down, buy a piece of real estate, cash flow that real estate, and in this instance, your hedge against the downside is that the bank is actually taking the most risk. The risk you are taking is your credit score and the down payment, but in this example, you would be able to buy a property that starts you on the road to wealth without taking all of the risk. And while you listen to me explaining this statement, it might be counterintuitive because you might be perceiving debt itself as a risk. So I'll end with this. The debt is only a risk if it is a bad investment with bad terms. There is one goal when it comes to investing, and that goal is income. Income is the outcome, period. So if you are buying an investment that is going to lose money every single month, ask yourself, why are you buying this investment and how long will it be before this investment makes me money? Which brings me to my final takeaway that I mentioned earlier in this video, and that is how to tell using these metrics where the housing market is going. Are prices going up or will prices go down? And in a nutshell, the easiest way to answer this question is by asking the simple question, is this a good investment? Meaning if you go online and you look at houses for sale and you start to do the math and realize that none of the houses for sale are for sale at a price that makes sense from an investment perspective, then guess what? Housing prices are going to go down because no one wants to buy an investment that they cannot use to make money. And although this is a gross oversimplification of the concept, it is the easiest and simplest way to understand whether or not the housing market as a whole is overpriced or underpriced. And this is why you want to look at all of the metrics we discussed in this video to determine whether or not it makes sense to buy a given property. And like I promised earlier in this video, right now there's a link popping up on the screen that explains how you can get money out of your property when it goes up in value without having to sell the property and without paying taxes. And that's why rich people do this, and it's one of the greatest wealth hacks on the planet. So if you haven't done so already, make sure you smash that like button and subscribe to the channel and watch this next video.